Hello friends, good evening to all of you, and we have already covered the module B, right? And module B and module A are the most important modules that I've already told you. So do confirm the audio video quality at the earliest so that we can proceed for today's session. We were covering the chapter related to technology in the international banking, and we have already covered much important concepts so far. So do confirm the audio video quality at the earliest so that we can proceed with today's session. So the audio video is working all fine. So let's start the session. Let's talk about the CRE-RH. Now, do you know that even for the standard loans, we are to maintain the provisioning. Like for direct agriculture, if we're talking about the direct agriculture and SME advances, we are to maintain 0.25% of the provision. For the standard loans I'm talking about, provisioning I'm talking right now, right? I'm talking about the standard loans, right? And if we're talking about the other categories, then we have to maintain 0.40%. If I'm talking about the CRE, commercial real estate, then I'm to maintain 1% of the provisioning. If I'm talking about the CRERH, commercial real estate, residential housing, then it is 0.75% of the provisioning which is to be maintained. Right? So if there is a residential housing project which is under the commercial real estate, so that will be having the lesser risk associated with it, lesser volatility with it. So that will be having lesser risk. In that scenario, what will happen? Now CRERH will be having a lower risk weightage of 75%. The CR is having the risk weightage of 100%, but CRERH will be having the risk weightage of 75%. Right? Now, let's move further. Further, it's related to non-market related off-balance sheet items. Non-market related off-balance sheet items. Now, what are off-balance sheet items? Which are contingent in nature. Not going to crystallize right now, but may crystallize in future. Now, those also expose the bank. So that is also to be considered as an exposure, right? That we already know, right? Let's say case the PNB Bank has extended the guarantees amounting rupees 10,000 crores. Rupees 10,000 crore of the quantum guarantees are issued. Now this 10,000 crore is a liability on the bank. It's a liability. It may crystallize at any time. So that is also to be converted into credit equivalent, right? We should also be converting into the credit equivalent that there can be a credit equivalent amount related to it, which may be imposing a risk upon the bank, right? So whenever we are to convert this particular exposure amount with the CCF. We say it to be the credit conversion factor. So here is a table related to it. Let's take the case that we are having a direct credit exposure substitute for all the guarantees. Direct credit substitute for all the guarantees. It may be including the standby letter of credit, right, which is a substitute to the bank guarantee, right? Or it could be the co-acceptance, right? In that scenario, the CCF is 100%. And if you're talking about the transaction related contingent item like performance bond is there, bid bond is there, which is transaction related contingent item, or indemnity is there, warranty is there. In that scenario, the CCF is 50%. If you're talking about the short term self liquidating trade letter of credit, right, where the goods are actually moving, right, for both the issuing bank and the confirming bank, right, this particular exposure is going to be both for the issuing bank and the confirming bank, then it is 20%. And if there is sale and repurchase agreement or the asset sale with the recourse basis, then it is 100%. And if there is note issuance facility, or let's say revolving or non-revolving underwriting facility, if there is some merchant banker and that has given a revolving or non-revolving underwriting facility, then it is 50%. Is that clear? So we have to keep in our mind the CCF factors also. You should be taking a look at it also. That what is CCF? Let's say your exposure is 1,000 crore. off balance sheet exposure is 1000 crore, right? And it is self liquidating trade letter of credit short term basis, then the CCF is 20%. 20% of the component is to be considered. The 20% component is to be considered. Now what will be doing? 20% will be leading it to 200 crores. Now 200 crore is not a risk weighted asset, keep in mind, right? This is just the CCF value that we have taken right now. So we were having an off balance sheet exposure, we multiplied it with the CCF so that we can be having a equivalent exposure value. Now this resultant credit equivalent exposure value is to be multiplied with the risk weightage percentage that is applicable to the counterparty. Let's say if it is a bank, then it could be lesser one. If it is a corporate and it is unrated, then it could be higher one. Let's say in that scenario it is 100%, right? And if it is having a lower risk category, or sorry, higher risk category, then it may be even be above 100%, right? So that further we have to multiply it with the risk weightage percentage, right? Then we'll be able to get the risk weighted asset, RW we can say. Okay. Now let's have a look at the use of credit rating. So RBI allows that you can be using the credit rating which is given by the credit rating agencies. There are different credit rating agencies. We are having the domestic credit rating agencies. We are having the international agencies like S&P, Fitch, Moody's, right? S&P is Standards and Poor's, right? And in India we are having the Brickwork, Credit Analysis, ICRA, CRISIL, right? Samira. We are having the different credit rating agencies, right? And further rating symbols which are associated with the risk-weighted assets. Let's have a look at it. So if it is on long-term basis, triple A is indicating very good, triple B is indicating low, D is indicating defaulted, unrated is carrying 100%, right? So that's related to the credit rating. As I told you that you will be multiplying the credit equivalent amount with this particular percentage, right? So even if you're having some investment or you're dealing with some counterparty, you'll be going for their credit rating. That what is their credit rating, right? And credit rating is divided into two parts. It may be for the long-term purposes or it may be for the short-term purposes, right? For long-term purposes, the symbols are AAA, AA, triple B, double B, C, D, and unrated. UR we say it to be. And in case of short-term basis, we are having the credit rating as A1 plus, A1, A2, A3, A4. Like in the case of the commercial papers, the minimum credit rating which is required is A3. If you are to issue the commercial papers now, the minimum credit rating which is required by a company, corporate is A3, right? So you should be keeping such things in your mind so that you can correlate them and can be memorizing them. Okay. Is that clear to you? Further, it is related to amendments in the Basel III framework. So there were amendments. We have already read them so far. I have already given you an idea related to it. Like I told you that revaluation reserves used to be a component related to tier 2 capital beforehand. But right now those are under the CET1 capital at 55% discount. Foreign currency translation reserves which arise due to the translation of the financial statements can be taken as a part of the CET1 capital, but limited. There is a limitation related that you need to discount foreign currency translation reserves by 25%. Deferred tax assets, those can be a component, but those are also to be limited maximum to 10% of the total CET1 capital. These are to be limited to. I've told you the concepts related to the Basel III. Related, I told you that what is standardized method or standardized approach for the credit risk, also related to the internal rating based approach, whether it is FIRB or AIRB, advanced internal rating based approach. I told you about the components of the capital, and this case study which is mentioned over here, it's related to the components of the capital. Case study on the capital requirement. So it says that we are provided with the different data. We are provided with the authorized capital, paid up capital, statutory reserves, PNCPS, perpetual non-cumulative preference shares, premium in PNCPS, debt capital instruments for tier 2 capital with the residual maturity of 3 years and 6 months, general provision and loss reserves, and the revaluation reserves. I'm going to number all these terms first of all. 1, 2, 3, 4, 5, 6, 7, 8. So in total, we are having 8 components which are mentioned over here. So first of all, you need to classify all these components one by one after one. You need to tell me that number one would be authorized capital is related to what component of the capital. There are 3 types of components, as I told you. Either it could be CET1, common equity tier 1 component, or AT1 component, or it could be the tier 2 component. So if I talk about the component 1, that is numbering 1, which capital it belongs to? Kindly do answer at the earliest. Do message over here so as to participate. The more you participate, the more you'll be able to learn the concepts. So do participate at the earliest. I request you all to participate at the earliest. So authorized capital is not related to any type of the capital. It is not related to the any type of capital. So it won't be related to any of it. Paid up capital at the end of the previous financial year. This is the component related to the CET1, AT1 or tier 2 paid up capital. It is related to the CET1 component, common equity tier 1 component. Statutory reserves. Statutory reserves are also related to the CET1. After that, PNCPS, perpetual non-cumulative preference shares, that's related to additional tier 1 capital. Premium in PNCPS, again related to additional tier 1 capital. Debt capital instruments for tier 2 capital with a residual maturity of 3 years and 6 months, it would be the tier 2 capital. As mentioned, it's related to the tier 2 capital. General provisions and loss reserves, again tier 2 capital. Revaluation reserves, that is related to the CET1. Previously those were accounted for tier 2 capital, but now that's related to CET1, that is under the tier 1 capital. Is that clear? The first point here, it says that we need to calculate the CET1, common equity tier 1 capital. Common equity tier 1 capital. So let's write down the terms over here. So it's related to 2 plus 3 plus 8. Is that clear? So there are 3 components, 2 plus 3 plus 8. So second is having the amount of 3000. All are in crores. So it is 3000 plus 2250 plus 2500. Right? So there are 3 components under the CET1: paid up equity capital, statutory reserves, and the revaluation reserves. But the revaluation reserves are accountable at 55% discount. At 55% discount means only 45% of the value of 2500 is to be considered. So it will be 3000 plus 2250 plus 2500 minus 55%. So if we calculate, kindly please do carry simple calculator with you. 2500 minus 55%, that is 1125. So this term here would be equal to 1125, and we'll be adding them all. So it is 6375. So your CET1, common equity tier 1 capital, is 6375 crores. Here they have simply asked to calculate the CET1, not the ratio. We can also be calculating the ratio if it is asked in the exam. So what will be the CET1 ratio? If we are given to calculate the CET1 ratio or percentage, how it can be calculated? It is a CET1 capital. Formula is CET1 capital, and further divided by what? Divided by the total risk-weighted assets, which in the question are given to be 90,000 crores. So we'll be taking the sum total of the risk-weighted assets. So that would be equal to 6375 divided by 90,000 multiplied by 100. So that is 6375 divided by 90,000 into 100. That is 7.08%. So the CET1 percentage is 7.08%. Is it clear so far? Kindly confirm at the earliest. If the concepts are clear to you, and if I have understood the topic related how we can calculate the capital, because such kind of questions are definitely to be there in the exam. Definitely you will be asked about such type of questions in a way or another, right? Another one this says this one only. So we have already calculated this, right? We have already calculated this thing, so we are not going to solve it again. Let me just bring the solution down here, right? So the answer should be mentioned somewhat over here. Is that clear? So we have already calculated it. CET1 capital ratio, how it is to be calculated. I just told you the formula related to it and everything. We just calculated it. The next one, it says that we need to calculate the AT1. That is the additional tier 1 capital. Now the components in the AT1 are related to what? Either it is PNCPS. In case of CET1 we are having the 10 components, but in case of AT1 we are having only 3 components. PNCPS, perpetual non-cumulative preference shares, plus share premium of the PNCPS, if there is share premium of the PNCPS, plus if there are any perpetual debt instruments. Those would be related to the 3 components of the AT1. Here in the question, PDIs or perpetual debt instruments are not given, so only 2 components are there, right? PNCPS and share premium for the PNCPS. One it is 2000 and the other one it is 200. Okay, so for PNCPS it is 2000 and for share premium of AT1 it is 200. So the total would be equal to 2200. So AT1, that is additional tier 1, is 2200. But if you mark this answer 2200, it may be wrong. It may be wrong. Why I'm saying it may be wrong? Because I told you that AT1, in case of AT1, PNCPS and share premium of PNCPS, it is to be restricted up to maximum of 1.5% of total risk-weighted assets. So whatsoever the total risk-weighted assets, it is to be restricted. The PNCPS and share premium is to be restricted maximum at what point? Maximum of 1.5%. Is that clear? So here we are having the total risk-weighted assets to be 90,000 crores. If I'm not wrong, let me just double check it. Yes, it is 90,000 crores. Okay, so 90,000 crores multiplied by 1.5%, that would be equal to what? 1350 equals to 1350. So this is leading to what? That the maximum amount can be of 1350, but the amount that we are having as capital available is 2200. So the accountable amount is only 1350. Let me write over here so that whenever you revise you don't get confused. So accountable amount is what? It is 1350. And what about the rest of the amount? The rest of the amount will be accounted toward the tier 2 capital. So it is 2200 minus 1350. That is 850. That is 850. Now this 850 would be accountable toward what? It will be accountable toward the tier 2 capital. Toward the tier 2 capital, right? Now the AT1 ratio would be equivalent to what? 1350 divided by 90,000, and that is 1.5%. So the answer is very much clear about this ratio. Clear so far? Please confirm at the earliest. Right. Now let's move toward the next question. It is about calculate the tier 2 capital. Now let's have a look at the tier 2 capital. It's quite interesting, right? Because there are some restriction toward calculation of the tier 2 capital, and we should be looking into all the possibilities which can be there. That's all about solving the question is. Okay, so we are having for the tier 2 capital, we are having number 6 and 7 only. Number 6 and 7 is related to the tier 2 capital. So it's one thing, it's related to the general provision and loss reserves, that is 1600. And further, we are having the debt capital instruments tier 2 capital with residual maturity of 3.5 years. Okay, so let's go to the question again. So it says under the number 7, we are having general provisions and loss reserves. General provisions and loss reserves. Now this amount is 1600, right? This amount is mentioned to be 1600. Okay, and the another one, it's related to the debt capital instruments, DCI, debt capital instrument, and we were having the residual maturity of 3.5 years. That was given to be 800. It was mentioned to be 800. That was the scenario. Now, for the general provision and loss reserves, the maximum limit is 1.25% of the total risk-weighted assets. For the total risk-weighted assets, 1.25% is accountable toward the general provision and loss reserves. So total assets are given to be 90,000 multiplied by 1.25%. So it is 1125. 1125. So 1125. Only this is accountable toward the tier 2 capital, right? And not the other one. Plus the DCI is given to have the residual maturity of 3.5 years. Now I told you very much clearly about the debt capital instruments. What it was all about. That in case of the debt capital instruments, if there is given to be residual maturity, you have to follow a table, right? If you don't memorize the table or remember the table, let me just tell you. And on the other side, you have to write the discount which will be charged. So when it's related to residual maturity less than 1, 2, 3, 4, and 5, and discount would be like 100%, and then step it by 20, 80%, 60%, 40%, and 20%. Is that clear? Is this clear to you? Please confirm. Right. So we are having the residual maturity over here. And in the question, we are provided that we are having the residual maturity of 3.5 years. Means lesser than 4 years, but greater than 3 years. So it will be related to here. Less than 4 years. Okay. Less than 4 years. So the discount of 40% would be applicable. So we have to deduct the amount of 40% here. So 800 minus 40%, that is 480. So 480 value is to be considered. Is it clear? Please confirm. Is this point clear to you so far? Right. So it is 480. Okay. After that, another amount is to be added up. And that amount is related to what? That amount is related to the difference of the 81 or surplus of the 81, which was 850. That is also to be accounted for tier 2 capital. So 850 will also be related to the tier 2 capital. Okay. So it is additional 81, I can say. It was related to additional 81. Right? Something like this. Now, the total would be equal to 1125 plus 1125 plus 480 plus 850. That is 2455. 2455. That is your capital. But there are few some checks which you need to keep in mind. First of all, the first check is related to that the tier 2 capital cannot be or should not be more than 50% of the total capital. Should not be more than 50% of the total capital. That is a one point that we need to check, and that's not the case over here. Total capital is way more. Like we have already calculated like 1350 for the 81, and for CET1 it was 6375. So definitely that is not the case. And the second scenario, it says that the tier 2 capital at no point should not be more than 100% of the tier 1 capital. So that is also not the case. Total tier 1 capital is equal to 1350 plus 6375. That is 7725. And that's not the case, right? So tier 2 capital is 2455, and that's all fine with us. But we need to check. We need to check all the criterias. Okay. So that's the case. Tier 2 capital we have calculated. Now calculate the total capital required. Now the total capital is required to what? It is tier 1 capital plus tier 2 capital. Tier 1 capital plus tier 2 capital. And in tier 1 we are having the CET1 plus 81 plus tier 2. So these are the components. CET1 we calculated to be 6375. Kindly please do check the figures again. 1350 over here. And tier 2 was what? We just calculated tier 2. It is 2455. It is 2455. So it comes out to be 6375 plus 1350 plus 2455. That is 10180. So this is a total capital. Total capital. And if we are to calculate the CAR, that would be equal to total capital. Total capital divided by the total risk-weighted assets. Total risk-weighted assets. And multiplied by 100. So we are given total capital to be 10180. Total risk-weighted assets are given in the question itself, 90,000 multiplied by 100%. So that is 10180 divided by 90,000 and percentage. That is 11.31%. 11.31%. And that would be the correct answer here. Is that clear so far? Kindly please confirm if you're clear with these points. Please do confirm at the earliest if you have understood this particular case study, because this is way much important, very much important, so as to understand. So do like the video and further share the video at the earliest, and simply just do write CAIB. If you want to get the complete pack, complete course related to all the 5 papers of the CAIB, just simply do WhatsApp CAIB and WhatsApp it to the number 83609 I'll be sharing the complete details to you, like, and you'll be getting the full course videos, chapter wise previous year questions, mock test, mega test, PDF notes, each and everything. The case study videos will also be covered, right? So that will be all. Thank you so much, and see you again in the next video.